again, the 4 phases of fundraising, this is not a general VC methodology, if you will. This is something that we put together, again, in efforts to help get our founders to think strategically about an effective fundraise. So whenever we talk about fundraising, we want people to think about it systematically as opposed to doing it whenever you have to because you're running out of money, or because or just doing it ad hoc because maybe an investor reached out to you, or maybe you had a conversation with an investor and so you feel like now you have to start fundraising. We think that by coming out and fundraising and running an effective process, you will increase your likelihood of finding the right type of capital, the right amount of capital from the right partners that you want to join you on this journey. It starts with thinking about it from a timeline perspective. So here you have the actual 4 phases, and we recommend folks start thinking about this with enough time ahead of you running out of cash, so that you are not scraping and struggling to try to close a round with only a couple of weeks left of runway. That is stressful for everybody involved. And so you want to work backwards from when you want to close a round and start. The other slide that we'll get into this is you also want to make sure that the business is at a place that is going to make you feel confident about actually fundraising as well. From a 4 phases standpoint, the first phase is the heaviest, if you will, in terms of work required on your end. This is the preparation, getting all the documents and materials put together. But if this is done really well, you've practiced your materials, you've vetted it with other founder friends, with investor friends, etc. This will make the other 3 steps go a lot smoother. And we'll get into each one of these shortly in the following slides. Pitching, this is just what it sounds like is pretty straightforward, but it is the important part of actually putting yourself out there, having conversations, meeting investors, sharing the vision that you have for your company. And then after that, hopefully you have interest from one or multiple investors, and you are now choosing the best investors to join you on this journey for the next stage of the company's trajectory. And the timeline here, again, we'll get into it in the slide. It really depends on the structure of the investment, whether it's a priced round, a safe, a convertible note. Each one of those has different nuances, which I'll get into very briefly, but we could have a whole nother Slauson Spaces on that if we really wanted to. And then lastly, it's the closing, which if everything was done right, this is pretty streamlined and straightforward. Everyone is wiring, signing the documents. The lawyers that you have are on board, they're in sync, and things are moving along. I'm going to get into the preparation, but maybe I'll do a quick pause to see if anyone has any questions on anything on this slide. Going once, going twice. Alrighty. So preparation, heavy slide, but again, don't expect you to take notes on this or to memorize any of this. No photographic memory needed for today. We're recording this for the purposes of you having this, and we'll put it on our YouTube. Preparation. So it starts with your documents for your company and also for your fundraise. So on the fundraise side, the first bullet here is we want you to have a vetted list of investors that you are going to reach out to, as opposed to just downloading some list offline and what we call spraying and praying, blasting your materials out to hundreds and hundreds of investors, hoping and expecting that somebody might reach out to you and respond. That is a way that you can fundraise. We don't find that the most strategic, and so this involves a little bit of work, putting together your own prioritized emphasis on that word, list of investors, which means doing your research, understanding their investment theses. Again, I introduced ourselves. I shared where we invest in. The deck that we shared has even more details to give you a sense of the kinds of companies that we looked at. You can check our portfolio page on our website to see more. And hopefully by seeing the information that you have online, hopefully talking to different folks involved with that fund, or reading things that they've published, you are able to figure out, okay, this is somebody who I think will be a really great fit and partner for what I'm looking for, where the company is at. So you're going to move them higher on your list than you would somebody who might be more of a generalist investor that doesn't look at your sector or industry or geography, et cetera. So really important. We recommend over 100, a list of over 100 investors. I've heard of founders having 200-300 investors on their list. That sounds like a lot of firms that you want to reach out to, but at the end of the day, it does come to be a little bit of a numbers game because there are literally thousands of venture capital firms. You want to figure out who's the right partner for you. So big emphasis on prioritized list of investors. And the next one is the materials for your actual company. So this is what we call a data room. A data room is just a fancy word. And I think we actually have a recording specifically talking about data rooms, which is on our Slauson Spaces YouTube. But data room is just a repository, a Google Drive, a Dropbox, a DocSend, whatever you prefer to house all of your documents. And the most important document, which is the pitch deck, because that's typically the first impression someone gets whenever they get your email, they see your submission on their website, they read your LinkedIn message, whatever, typically going to lead them to your pitch deck. And so you want to make sure it's a strong first impression. We have seen some of our founders on their own work with deck designers. There is a cost to this, roughly of somewhere between 1,000 to 5,000, sometimes north of that, depending on how many revisions you want. While that does sound like a lot of money, and it is, in the grand scheme of things, of you trying to get $1, 2, 3, maybe $5 million, it goes a long way, and it might be a good investment. So something to look at and consider. The pitch deck, again, we could go in on a separate topic solely on the pitch deck itself, but very important. And then these other documents could be supplemental. The financial model, people want to understand how you're going to make money, how big is this going to grow, what is your plan primarily for the next 1 to 2 years, which is whenever you're fundraising for the capital that you're raising and you're asking for. So we want to know that you have thought about, if not just from a revenue standpoint, if you're pre-revenue, then at a minimum from a cost standpoint, how long this capital is going to last you and what you're hoping to accomplish with it. So your financial model, and then a hiring plan and a product roadmap. We want to understand who you plan to join you on this mission. Do you already have them identified? Where are they located? What are their titles? What are their roles? What is their purpose in the firm, in the company that you're building? And then on the product side, what is the evolution of the product? Are you going to add new features? Are you going to turn on monetization in a few quarters? We want to understand that. And these are all, to me at least, pieces of different puzzles that we're trying to piece together. And you're helping us do that by having all of your materials ready, having your pitch very crisp, succinct, and structuring it in a way that you are addressing our questions even before we ask them, so that we can get through the basic stuff and actually get into really meaty, substantial questions about the company and what you're building, and ultimately figure out if there's a good match between our firm and your company. This is a list of a bunch of other things that you could include. We have them as optional because it really depends on the size of your company, the stage of the company. So I won't read them all here, but the one thing that I will call out here is an FAQ. An FAQ is important and helpful because maybe there are very nuanced questions about your industry or about your product that isn't necessarily worth putting in the pitch, but you want to have that somewhere. So a simple Google Doc or Notion page to start to fill out FAQs of questions that you get every now and then could be helpful to have in your data room. And then whenever someone asks a question, you can just copy and paste that or include the link to that. And it makes your life and the investor's life a lot easier. On the fourth bullet, hopefully you are working with or planning to work with a reputable startup law firm or startup attorney. it goes a long way to again, this is one of the things where it's going to sound expensive, but we've seen more than a handful of times somebody that worked with their friend's friend that is a lawyer but not doesn't do startup law, and but they want to do a side hustle, and so they might be willing to work with you on a much cheaper at a much cheaper rate. But you really want to have somebody who understands startups, because the beginning of a company will be very important for setting the foundation for future rounds. And so if you have the beginning, if you do things right at the beginning, as you progress through different rounds of financing, you're not going to have to worry and clean things up, if you work with a reputable startup attorney, as opposed to if you didn't, you're going to have to spend even more money in the future potentially, because those lawyers didn't pay attention to something that was very basic that most startup lawyers did. So due diligence on who your legal counsel is. A lot of times, a lot of law firms are willing to work with early stage startups at reduced rates, because they know that in the future you will hopefully be generating a lot more revenue and can pay them a lot more than you would at the beginning. So I emphasize that. And then the last step here in the preparation is actually doing the outreach to investors. This is where a very succinct email blurb or written blurb comes in handy. Again, this is another slightly more of an art than a science, in that you want to write something that's exciting, going to catch people's attention, and ultimately get them to click on the pitch deck link so that they can agree to take that conversation with you. You want to do this early, in the sense that you don't want to just blast these out and say, hey, I need to talk to you today because I'm fundraising and you have to invest in my company by the end of this week. That's typically not how things are going to happen. And so you want to say, hey, I'm fundraising at the beginning of August. If you reach out to them today, that you would love to send up time with them. That way you are giving them time to review the materials, and then time to set the time on the calendar, so that you're not frantically trying to get on their calendars, and they are able to actually put you on their calendars. I mean, generally speaking, we want to talk to founders. That's our job, but we are talking to dozens and hundreds of founders on a regular basis. And so being able to plan 1 to 2 weeks ahead goes a long way, and it helps you really focus on, hey, okay, I'm actually going to have these 2 weeks where I'm only talking to investors. Obviously, you're not only doing that, but you're trying to put as many of those conversations in that time block, so that you are able to, your speed of getting better at pitching is going to increase. You're going to get so much better at pitching in that short time frame that it even matters. Like, hey, I really like this firm. They're a tier 1 firm. I want to schedule them at the end of the first week, because I think that I'm going to have be in a lot better of a flow by the end of the week than I would be if I was pitching them at the beginning. So all of these small nuances that hopefully you can control. Sometimes you can't, but you have a higher likelihood of being able to control them if you are thoughtful, proactive. Things to watch out for, which is things that we tell, again, our founders. Being preempted, what that means is a firm reaching out to you to say, hey, I want to learn about what you're doing, get some information, understand what you're up to. While this is very flattering oftentimes, that you don't know that investors' ultimate intentions, and not to say that investors are bad, but they are effectively trying to get information. If you're not fundraising, this could be a big distraction. It could be a time suck, and it ultimately could not lead to an actual offer. There, just because they reached out to you doesn't mean that they have to invest in your company. And so this is why we talk about running a process, and emphasize a process, as opposed to just, oh, hey, this investor reached out, I think they're interested, I'm going to start fundraising now and hope that this one investor actually invests in me. Again, we've seen that happen, and it ends up draining a lot of the founder's time and energy, and being a distraction, and doesn't lead to an offer. It can, but you want to be really careful about that. Second, unfavorable market dynamics. So there's typically there's a 1 to 2 quarter lag for startup VC data. There's PitchBook, Crunchbase, Carta, a number of other places that you can get information about what's happening in the venture capital market. Um, for those that have been following it for a few years, in 2021, there was a huge uptick in number of funds started, number of companies started, a lot of capital that was being deployed. And then 2022 started to taper and come down, and then really was a big drop last year. And I think now that drop is stabilizing, but it's stabilizing at a much lower level than 2021. And so, and then you have AI and what that's doing for deals, and how that is impacting valuations and whatnot. So you just want to have an understanding of where the market is. You do this by seeing those reports, but hopefully having conversations with other founders, maybe a founder who's 1 to 2 steps ahead of where you want to be, and then maybe some investor friends that you feel comfortable really asking about, and having a candid conversation about, hey, for seed deals in B2B SaaS, what are some of the metrics that I need to be mindful of, so that whenever you are pitching investors, you're not doing it kind of with a, you are doing it and you are you understand what the market is expecting from you, as opposed to just doing it and hoping that what you have to offer is meeting the market demands and needs of that specific time. A lot of this is going to become dependent on, again, the stage of your company. Is it B2B? Is it B2C? This is a pre-seed deal, a seed deal, et cetera. But it ties into the third metric, or the third bullet here, lack of clarity around key metrics for your company. So this is where you want to be very crystal clear about, okay, if you're a consumer social company, you want to do a lot of research, have a lot of conversations about what is expected of a consumer social startup, so that if you fundraise and you have more than what certain people are expecting or less than, you are setting yourself up for the appropriate timeline or likelihood of a fundraise, based on where your business and key performance indicators are. I'll do a pause here to see if there are any questions. Again, this is the heaviest step of the phases, that, because of how much work is involved on your end. But if it's done right, the next 3 steps will move a lot smoother.
Jesús, I have a question. This is Delroy at Insight Connect. Unfavorable market dynamics. Can you explain that a little in more detail?
Yeah, sure. So again, let's say your company was run in 2021 and you weren't fundraising at that time, but you saw a bunch of your founder friends fundraising, and they were getting a lot of money at very favorable valuations, and then that makes you excited about that, and you're like, oh man, I'm not fundraising, but like, they are having a really good time. They're getting money. If you see somebody that's fundraising and maybe like you have more than that company in terms of revenue or customers or whatever, then you get excited and you're like, all right, I'm going to fundraise too, because I think that this is a good time to do that. But then on the back end of that, let's say you started, because you thought that, you started fundraising at the beginning of 2022 when you saw this big drop, and you didn't really understand what was happening, because things don't happen over days. It happens over weeks, months, quarters. But at that time, a number of things were happening in the economy, interest rates, et cetera. But and you see the numbers from a total capital deployed, number of deals done, there's a huge dip. And so if you're fundraising right at that dip, you don't know that dip is happening. But if you're talking to investors, founders, and you're saying, and the founders are saying, hey, it's actually taking me a lot longer to fundraise now, you're getting these signals that are helping inform your strategy, as opposed to just assuming and thinking that, hey, my friends fundraise in 2 or 3 weeks, I'm going to fundraise in 2 or 3 weeks and be done with it. Or I mean, I guess you could have the opposite be the case too, expecting to take a long time, and then the market picks up really quickly. I think right now that there is hope and expectations for the market to pick up, in the sense of more deals being done, And so in theory, that should be a good time to fundraise for founders, as opposed to trying to fundraise, let's say last year, whenever the market was trying to figure out let the dust settle from 2021. A lot of companies have gone out of business. A lot of companies are raising bridge and extension rounds. And then there's also a lot of completely new companies fundraising for the very first time. So from an investor standpoint, we have a lot to choose from, which is good, but it also makes it hard and difficult in a positive way for us to figure out, is this company on doing very well, and they have very exciting metrics, are on a very good trajectory, or they're struggling and they're just trying to keep the lights on and trying to fundraise, and this is a bridge or an extension without them calling it a bridge or an extension. There's also a number of down rounds or recaps. So people that raise at very high valuations that are now raising at half that valuation or even less, or people that raised at a high valuation that are what's called a recapitalization, where all the investors are getting their ownership is going down because they're raising at a much lower valuation. So that's what's been happening. And you as a founder want to just understand as much as you can about what's happening so that you are setting your expectations up accordingly.
Thank you.
Yeah, thank you. Alrighty, so we'll jump into the next step, which is the actual formal pitching process. You're not going to fundraise without pitching. It's important. I know fundraising or pitching isn't sometimes the favorite thing of a founder, but it's your chance to sell the company hundreds and hundreds of times likely, because investors want to know that you can sell the vision, that you can hire great talent, and that you can fundraise, because those are three things that are needed of a great startup CEO. So on the first bullet, depending on how much capital you raised to date and how many investors you have, you want to make sure that everyone is aligned. This sounds kind of simple and basic, but again, we have seen cases where some investor was holding things up for not a great reason. And so just want to make sure that everyone is aligned, that you're probably keeping them updated via some sort of newsletter or investor update. So, or conversations, depending on how many investors you have. You want to make sure that they know that you're fundraising so that they're aware, and also can help you with introductions, etc. We went over a little bit about the data room, and we actually have one of the last slides around a list of the things that we had included, which again, you'll have access to on the YouTube, but make sure that the data room supports your pitch, your story. You want to make sure that all those pieces of the puzzle, people can put them together. Creating an investor tracker. So I mentioned that list of 100 plus investment firms. Keep things organized, more so for your sake. If you had a conversation, you can just say, you can put on a Google Sheet or an Airtable where you are in that firm's process. This also helps provide a clarity to your existing investors. If they have access to that, they can see, oh, you're talking to this firm. We just had coffee with, or we're about to have coffee with that partner. So it helps us triangulate and figure out, okay, is this a firm that we have a close relationship with? Should we reach out and offer to connect and talk about the company? But we can only do that if we have an understanding of who are the firms that you're talking to, where you are in their process, any feedback you're getting, and all of those things. So keep it organized, really for your sake, but also for benefiting from investors understanding where you are in your fundraise process with different firms. And then from a timeline perspective, again, we recommend keeping things as concise from a timeline perspective. So if you are saying, I'm going to be fundraising for these 3 weeks, first 3 weeks of August, for example, which probably isn't the best time because summer break, a lot of folks are traveling, etc. But let's say that was the case for you. You set up those first conversations in those first 2 weeks, or as many as you can. And then you should expect that of your 100 plus firms that you reach out to, a subset of that will actually respond to that. And that will lead to multiple conversations. So one call during those first 2 weeks leads to 2 or 3, or maybe even a fourth in-person meeting. This will be highly dependent and variable based on that individual firm's process. Each firm has different processes. So hopefully, as you have that initial conversation, they are able to share, or you're able to ask about what their investment process is. Or maybe this is actually a firm that you've been building a relationship with over a few quarters. And so whenever you are actually formally fundraising, it's less of an initial pitch and more of a conversation. And that's actually the most natural way to do it. But we understand that that's not always feasible or possible to do for hundreds of firms. You can do that maybe for 5 or 10, meaning you have a relationship. Maybe you met them at an event or at a conference or something else, and you've added them to your investor newsletter. And so they've been able to see the company through a couple of quarters, maybe even years in some cases. Some firms will literally tell you, we don't invest in you unless we've had a relationship for the past 2 or 3 years, or a minimum of 2 years, if you will. These are typically later stage investors, but just goes to show you that if you can get ahead, this is what I'm talking about from a process standpoint. But what's not here, at least on these slides, is the fact that you can and oftentimes should be building a relationship naturally in as much as you can with specific firms that you are excited about. So again, 5 to 10, so that whenever you are actually fundraising, they already know what you're up to, they know who you are, and it's a much richer conversation than if it's the very first time, which is going to be the majority of conversations. You're pitching folks for their very first time. But if you are able to, there's an article, a VC article out there written by one VCs that we invest in lines, not dots. I might be butchering that because I haven't had my coffee. But what that means is VCs want to see a trend. We want to see where the company has been, how the company has evolved. Not always the good. We want to see the bad because startups have rough times. And so if we are able to see that trajectory over time, that helps us make a much more informed decision about whether or not we feel like we're the right partners for this company. Versus if we have one data point or 2 data points from just 1 or 2 conversations, it's not impossible to invest just based off of that, but it's more challenging than if we had multiple data points over 1 to 5 quarters or even 1 or 2 years. So expect things to go from one conversation to multiple conversations over a certain time period. And then hopefully you get a term sheet, maybe even multiple, depending on the level of interest in the company. Some things to avoid goes without saying, but you want to be super responsive. This is the beginning of a working relationship, and so you want to put your best foot forward. On the second point, if you did the first step well, this shouldn't be that big of an issue. But if you've researched that firm, you're excited about talking to them for specific reasons, you understand the partners and their perspectives and their past investments, that's going to help you in that conversation to bring up maybe other portfolio companies that they have and talk about why you're excited about what you're doing, because maybe you see some similarities with that other company that they invested in, or maybe you talk to another founder in their portfolio and they shared an interesting story about how they helped that company, and you're excited about the level of support that they could provide. There's many ways that you can do it, but do your homework on the firm. That goes a long way to show that firm that, oh, this person does their homework, they do their research, that they come prepared, and hopefully puts you in a better light than if you don't do that. And the last point is, again, it is a relationship. It's not just a check. There are investors that are literally just a check. Typically, they will tell you that. I mean, for us, we take a board observer seat. We get pretty hands-on, particularly because of the amount of ownership that we aim to take, which typically is around 15%. And so because we want to support as much as we can, we want to make sure that we understand the people that we're going to do business with, as opposed to a founder that says, hey, I just need this money. I don't need someone to tell me what to do. I know what to do. And there are VC firms that will tell you, hey, we write the check, and that's all that we do. We don't get involved, we don't support, and sometimes that is a good match. The investor wants that, the founder wants that, but often, at least for us, we focus on it is a relationship, and so you want to treat it as such. Any questions here?
Yes, I'll go again, Jesus. I'm sorry about that. I'll knock out some time. So the first question I have is on the investment tracker. We had around 30 companies we were tracking. You say here 60 to 100. Is that realistic, or are we not being realistic? Should we have that larger of amount? Is the first question. Second question I have for you is the Slauson Co's ownership of 15%. Is that average generally across investors across the board?
Thanks for your questions. So if I go back to this slide, so on the first bullet, we recommend if you're a founder with a startup, you're going to be fundraising. We're telling our portfolio company founders to have at least 100 investors on your tracker. From a pitching standpoint, it's likely, but not going to be always the case that you're going to talk to that. If you just, like, let's say you have 100, that you reach out to 100, you're going to talk to exactly 100. So here it's targeting 60 to 100 firms from that 100 list. And of that, you're going to expect somewhere about 50% of them respond. So hopefully if you have more than 100 and the percentage is actually 50%, you're going to have more first conversations than if you had a smaller list. Again, this is just pure numbers. This is leaving aside the pitch deck, the actual where the company is in terms of performance. So the purpose of sharing initial outreach is like people who you're actually emailing, people who you're actually reaching out to, having an initial list of 100 plus. But if you have that 100 plus, if you have more than 100 and you're not getting a high response rate, you can continue to reach out to people. And sometimes it helps even to do it in batches. So let's say you reach out to the first 50, and based on that response, you say, okay, I want to get some feedback. I'm not getting a lot of responses. I feel like maybe my pitch deck isn't good or something else. And then you might try the next 50 batch of 50. So reaching out to over 100, but expecting that realistically only a certain percentage are going to actually respond. Hopefully I answered your question.
You did. Thank you, Jesus.
On the second point, it's a wide range. Some people are 20%, and some people don't have target ownerships. Some people are more of like, I write 100K checks or I write 1 million K checks. And this is really something that you have to understand, whether that's something that they've stated publicly or on their website or talking to founders, or they tell you directly whenever you have a conversation with them. That said, there is general rules of thumb in terms of fundraising for startups over time. There are charts that you can see, but you should expect to, from a dilution standpoint, to give up ownership of your company every round somewhere between 10 to 20%. So this, if you back into what an investor will take of that, it depends on that investor. It could be up to 20, or it could be as little as 1 to 5. But again, that's really going to depend. Do they lead? If they're a lead investor, which means that they're issuing term sheets, they're setting the terms of the deal, depending on the investment vehicle, which I'll get into in the next slide. They're probably going to be investing at least 50% of the round, more often than not. So if you're raising call it $2 million round and they're a lead, they're probably going to want to put in $1 million. Now, if they're a lead, they're probably looking for somewhere between 10 to 20% ownership. But again, that is even in and of itself, 10 to 20% is a pretty wide range. But it's a question that you can ask.
Is that negotiable? Just out of curiosity.
I mean, yes and no, in the sense that I wouldn't focus on negotiating it from the very beginning. I would have a conversation after they've made an offer to invest in the company and you react to that offer, because you want to understand, like, if you have 5 VC firms giving you term sheets, then it's definitely negotiable. But if you have one and you don't feel like you like those terms, then I would have a conversation about where is there flexibility. But if you start, not that you would, but if you start doing that from the very first conversations, they're like, I haven't even met you. I don't even know what you're doing. You're talking about getting a higher valuation than we typically get, that we typically look for. So you want to play it tactfully.
Thank you again.
Yep. Alrighty. We are running up on time, for better or for worse, but we'll breeze through these. Again, you'll have access to that.
Jesús. I had a question, if you don't mind me asking, please. I'm very sorry for interrupting you.
No worries at all. Please.
So I was wondering, when it comes to funding and like funders, no, when it comes to funding and investors requiring a small percentage of the company, does that also apply to nonprofit? Because I feel like the goals within the nonprofit sector is very different from like tech sectors and other funders that are on the call. So I feel like my organization doesn't necessarily like we don't necessarily have like share to give to someone if they would ask for return in the investment. But again, I want to ask your point on that, if that's something that applies to everyone, to both nonprofit and for-profit businesses.
So there's no shares in a nonprofit. Now you can get really creative with like structures. Like for example, OpenAI is technically a nonprofit, but they have a really unique legal structure. So you can get really creative if you have really good lawyer friends that can help you figure out ways to do things. But generally speaking, nonprofits don't have shares. So you don't have investors, you have donors. So you're not going to give up ownership in general for nonprofits. If you are taking outside capital, it's either a grant or it's something else, which is probably a loan of some sort or some sort of PRI, MRI. But yeah, this is all focused on startups. With nonprofits, that's a different way to go about it. So here, the third step, you've made all the materials, you've pitched dozens and dozens, if not hundreds of VC firms, and you've gotten hopefully a couple of firms that are really excited about supporting you. And so now it's time to decide the actual makeup of the round itself. The timeline for closing will depend on, again, the instrument. By instrument, I mean, if it's a safe, which is typically on the cheaper end, it's very clear cut, it's very standard, and there's only a few things to negotiate, generally speaking. There's a convertible note, which is a little bit more expensive, and there's an interest rate that could be negotiated. And then there's a price round, which is the most expensive, but the most legitimate, in the sense that at a price round, there's actually, shares that are being exchanged. Whereas with the first two, the convertible note is actually a debt instrument, and then the safe is just a promise of a future note for equity. And so the price round is, and there's charts about what's more common than not, but I would say at the pre-seed, heavily weighted safes and sprinkles of convertible notes. Seed, I'll probably say around 70%, or sorry, about 50 to 60% safes, and then the rest priced. And then later stage rounds, probably a little bit higher for price rounds, but safes still happen at even very late rounds, series B, C, etc. People can still do them on safes, and there's various reasons why someone would and wouldn't. But you want to just be you want to understand the dynamics of that. And again, we can have a whole other conversation about those. But if you're at this step, you're choosing the right partners. Hopefully you're doing your own diligence about how they are as investment partners, hopefully talking to some of their portfolio company founders whenever we make an offer. If that founder hasn't already talked to some of our portfolio company founders, we make that invitation. Again, you're keeping everybody who are prior investors in your company abreast of what's happening, so that they can invest if they have a pro rata clause. So pro rata just means if someone else has, let's say, 1% ownership in the company, and this is in their investment documents that they can keep that ownership, they have the option to invest 1% of that new round so that they can keep that ownership. This is something that larger investors typically ask for. We ask for it in our investments. So you want to make sure that everyone communicates how much they want to invest in the new round. And this is where the lawyers come in. They are doing their jobs in terms of looking at the legal documents of the company, making sure that there's nothing fishy going on with like the legal structures or the accounting. And again, if you have a good startup lawyer, this will go fairly smoothly, unless the company has like very unique structures or circumstances. And this is where there are some things that are negotiable. One of them being like an option pool, typically for a priced round. Option pools are set up so that you can hire talent in the future, and that you have enough stock options to be able to hire that talent in the future. And then there's side letters depending on additional things that investor might require. But generally speaking, fairly straightforward if you have your documents already lined up and your legal team is informed and ready whenever they need to come in. Any questions here? Alrighty, if not, the last step, which is fairly straightforward, is just actually closing the round. So at this point, it's actually getting into wiring of all the documents, signing of all the documents, and then wiring of all the money. Hopefully you've done this and you still have a few months of runway left so that you're not scrambling. Everyone, there's no delays. Somebody's not out of office for a month because you need their signature and not delaying the process. And then typically, at least from our standpoint, whenever we're sharing this with our companies, if we invested at their pre-seed, now they have a new investor at the seed, and let's say that investor is going to take a voting board seat, there's going to be a board meeting that they're going to have to set up now and moving forward. So that's something that we want to make sure that they are mindful of and get ahead of in terms of making sure that they're setting that up and prepared for that, because that's going to be something that's going to have to occur for the rest of the company's trajectory. Typically at the pre-seed stage, you have a board legally, but you don't have formal board meetings, although we actually do recommend at least one board meeting a year for pre-seed investments. But just as a way to get in the habit of what will come in the future whenever you do have outside investors coming in and taking voting board seats. So if you got into this step, things are going well. And just some final comments. So I talked at the beginning about timeline, and you want to make sure that you're fundraising and you're not doing it at a point of running out of capital. But oftentimes, I'd say the majority of companies are fundraising because they're running out of money. And so versus a small subset of companies, which typically are the ones that are able to get rounds done because they're fundraising off of an inflection point. And so you want to make sure that at the moment you're fundraising, the company is at this, what do we call inflection point? This inflection point can be very dependent on your specific company, stage, geography, etc. One example is, hey, you are a company that's focusing on expanding city by city, and you've now expanded to 2 cities. You have a very strong playbook of how to expand to new cities, and you've had great results with those 2 cities over time, and you're fundraising to now expand to 10 cities, and that's going to take your revenue from 10K MRR to 200K MRR in the next 12 months. And you have a CMO that you've been working with part-time that you're going to hire, and there's a number of things that you could say and could do, but in this case, that go-to-market playbook that you've been developing and refining and have in a very good place is sort of the inflection point that you're saying, we're fundraising because we know what we need to do, and we're going to do a lot more of that. That's going to yield positive results. This is one example. Other examples are key hires, launching the product, turning on monetization, etc. And so if you're fundraising and you have that data, let's say of 2 or 3 months, 1-2 quarters, that's showing how whatever inflection point you're saying has been going, that gets people excited. And hopefully it is a true inflection point in the sense of it's some equation that you figured out, it's some team member that you join that's been able to take the product leaps and bounds. That is what's driving the fundraise, because you're raising to do a lot more of that, as opposed to just fundraising to keep paying people's payroll for a company that hasn't been performing that well. And again, that well is relative to what other companies are performing at that moment in time. But generally speaking, if you're showing double-digit growth, 10, 20, 30+% month over month, that's very strong growth. And if we're just talking about users or revenue, and so if that is the case, and you understand why that growth is happening, and then the reason for that growth is the reason why you are fundraising to do a lot more of that, that's an interesting story. Again, as opposed to saying, hey, I'm running, like, you're not going to say this, but you're running low on cash. You got to fundraise because you got to keep paying people to try to figure out if you can figure out product market fit, etc. So the ability to fundraise successfully will be highly dependent on the momentum and excitement and inflection point of the company. If there is none, you want to be mindful of your likelihood and chances of having a successful fundraise. And so we share this early with our companies so that they can think about this as they figure out their hiring needs, their product launches, and structure things in as much of a way to choreograph, if you will, a successful fundraise where you are hitting an inflection point, and that's driving the fundraise. This is a list of things that we would recommend are in your data room. Again, you don't have to have all of these things. These are things that we recommend. The first 2 or 3 things are things that we see as bare minimums: pitch deck, financial model, which we already talked about. But then there's a number of other things that you can have depending on where your company is as well.